The collapse of the deal between Enron and Dynegy has left Enron employees stunned, many of them wondering if they'll be getting their next paycheck.
It starts with good people. Recruiting, retaining, motivating.
It was one of the most
people,
admired companies in the world.
Really,
it was
have the
fast,
capability of
futuristic,
thinking about the world a little differently.
and fake.
And if you have
In
good
2001,
people, you have that good
Enron went
environment,
from Wall
they
Street
start coming
darling
up.
to one of the biggest bankruptcies in American history.
This woman.
Thousands lost their jobs.
Everything that's
Millions
going
lost
on.
savings. And the truth?
And you're
It was
sitting
built
here
on
as CEO
lies,
saying you just
greed,
decided on the same-
and accounting tricks. This is the rise and fall of Enron, one of the most shocking financial scandals the world has ever seen. Enron began in 1985, when two natural gas companies merged to form Enron Corporation. Under CEO Ken Lay and rising star Jeffrey Skilling, Enron pivoted from pipelines to energy trading. It positioned itself as a tech-forward, asset-light powerhouse, offering a futuristic energy market platform. Enron claimed it could trade electricity like stocks. It even launched Enron Online, a digital platform years ahead of its time. The stock soared. Investors poured in. Media couldn't stop praising it. In fact, Fortune magazine named it America's most innovative company, 6 years in a row.
Fall from grace.
What are you going to work on?
Ken Lay was more than just the founder of Enron. He was a local hero in Houston, politically connected. Many expected he was bound for Washington.
But behind the numbers, something was very wrong. Enron wasn't making real profits. It was faking them, using something called mark-to-market accounting. That meant they could book profits on a deal the moment it was signed, even if the money wouldn't come in for years
Tonight, there's a
or ever.
guilty verdict in the
To hide
obstruction of
losses
justice
and
trial of
debts,
Chicago-based
Enron created
accounting
hundreds
firm
of shell
Arthur
companies,
Andersen.
known as special purpose entities.
You were fired
These
by
companies,
Anderson last
like
week for
LJM
orchestrating
and Chuco,
expedite-
weren't truly independent. They were controlled by Enron's executives. Debt was moved off Enron's books. Losses were buried. But the balance sheets looked perfect. It was smoke and mirrors. But no one wanted to look closely. Not analysts, not investors, not even their auditor, Arthur Andersen. Number 4. Wait, what is mark-to-market simply? Mark-to-market, MTM, is an accounting method used to measure the current value of an asset or liability based on its real-time market price, rather than its original purchase price. In simple terms, it means updating the value of an asset or investment to reflect what it would sell for today in the market. Where it's used: trading and investments. Financial institutions use MTM to report the fair value of stocks, bonds, or derivatives they hold. Futures contracts. Gains and losses are calculated daily and settled between the parties. This prevents big losses from accumulating. Accounting reports. Companies may adjust the value of their financial holdings to reflect market conditions at the end of each quarter or year. Example: you buy a stock for $100. Today, it's worth $80 in the market. Using mark-to-market, your books now reflect the asset as $80, not the original $100. Risks. In volatile markets, MTM can cause large swings in reported profits or losses. It played a role in the Enron scandal, where the company booked future profits as current income based on overly optimistic assumptions.
The Senator yield for a question.
Mr. President, before I yield the floor, I would yield for a question.
Yesterday, AT&T announced that they were going to fire 30,000 people.
By 2001, the lies were too big to hide. A whistleblower, Sharon Watkins, warned Enron's board. The company could implode in a wave of accounting scandals. Soon, journalists in the SEC started asking questions. On October 16th, Enron admitted it overstated earnings by nearly $600 million. Wall Street panicked. The stock crashed from $90 to less than $1 in just weeks. On December 2nd, 2001, Enron filed for bankruptcy. It was the biggest corporate collapse in U.S. history at the time. 20,000 employees lost their jobs. Retirees lost life savings tied up in worthless Enron stock.
Mr. Lay, what would you say to the folks that used to work for your company?
I'm going to work right now. Right?
The collapse shook the world. Congress launched investigations. Arthur Andersen, the accounting firm that signed off on Enron's books, was convicted of obstruction and shut down. Ken Lay and Jeff Skilling were charged with fraud, conspiracy, and insider trading. Skilling was sentenced to 24 years in prison. Ken Lay died before sentencing. The scandal led to major reforms like the Sarbanes-Oxley Act, which made CEOs legally accountable for financial reports. But for many, justice came too late.
By my counsel not to testify based on my Fifth Amendment constitutional rights.
Enron was a symbol of modern business, a tech-driven, market-smart company. But it wasn't built on innovation. It was built on illusion. The story of Enron isn't just about fraud. It's about how people ignored warning signs, how pressure to perform led smart people to make terrible choices, and how a house of cards can look solid until the last moment. This was the fall of Enron, and it won't be the last financial scandal we'll uncover.